Good morning, colleagues. I'd like to start from the answer on the question I heard now. If you can make some forecast in Ukraine for 5 or maybe 10 years, if I'm asked such a question, my answer will be yes, of course, because of several reasons. First of all, the question is, are there any deals in Ukraine currently? The answer is yes. There are some deals, there are some businesses acquired, etc. The next question is, if somebody purchases a business, does he have any view on the future of the business? Does he make some projections? Yes, of course. If so, if our business environment is still alive, that means that any appraiser have to be able to make any projections and to make the required projections, and the projections are the main thing we have to do if our assignment is business valuation. When I was asked to make this presentation, first of all, I thought, what new I can tell to colleagues we are CFA members. But after that, I decided to concentrate only on some practical aspects related to valuation, which might be interesting for you. I'd like to start from some general concepts, just to be sure that we all are on the same page, and some commonly used terms we understand одинаково. Yeah, our understanding is the same. Yeah. Okay. I'd like to start from some concepts in accordance with international valuation standards. The latest reduction is 1917. First of all, the standard tells us that there are four levels of business which are used in business valuation. First of all, it is enterprise value. The next is equity value, total investment capital, and the operating value. The last one is not so widely spread, but sometimes it is also used. What is let's describe these all concepts from 2 points of view. First of all, let's see from the point of view of assets, what does it mean business? Non-current assets, current assets, minus current liabilities, minus cash. The standard tells us that it is the investment capital. Okay. So total investment capital is all invested funds minus current liabilities minus cash. Okay, from the point of view of liabilities, we see equity value, interest-bearing debt. It's some small mistake here. You will see now. Current liabilities. This is interest-bearing debt. Current liabilities. Then minus cash. And the IVS tells us that it is the enterprise value. So enterprise value is equity plus interest-bearing debt minus cash and cash equivalents available to meet those liabilities. It's important to be sure that we understand correctly what is required for our client when he tells us that he needs a business valuation. And these are the definitions from the IVS. You can find the same or maybe more or less same definitions in other materials, in other standards, including American Society Appraiser standards, RICS standards, etc., etc. Okay, let's go forward. Free cash flows to equity and to enterprise value. We know that there are several methods to make calculations of cash flow to enterprise value. These are two different calculations with the same result in the end. The difference here is that we are starting from, in the first option, we are starting from the EBIT, and in the second option, we start from the net income. And in the second option, we have to add to the cash flow debt servicing costs reduced by income cost. This is the only difference. They both will allow us to have the same result. It will be the cash flow to enterprise value, and the cash flow to the equity. You know this maybe even better than me, requires calculation and adding or subtracting the long-term debt change in the cash flows. Okay, this is some, I don't know, theoretical concepts, and now I would like to describe what I will try, at least I will try, to tell you about practical aspects related to business valuation based on my individual and my team's experience. It's sale of shares or equity, then enterprise value consideration for deal purposes, value of complex of fixed assets for collateral pledging. It's one of the most difficult issues for the local appraisers, Ukrainian local appraisers. Then economic obsolescence valuation. It is also connected with business valuation. Then one example of hotel business valuation. It will be quite short because I know that there is one topic related to commercial property valuation in our event. Then sale of chain of petrol stations, mining and oil and gas extraction company valuation, business of natural monopoly valuation, and a little bit about purchase price allocation. It doesn't mean that it will take us a lot of time. I'll try to concentrate only on the main topics which may be interesting for understanding of the specifics of the peculiarities of such evaluations. But let's start from the concept of assumption. What does it mean, assumption, in the context of valuation standards? Assumptions are matters that are reasonable to accept without any justification, investigation, verification. Then, what is a special assumption? A special assumption differs from where some facts, existing facts, differ from those existing at the date of evaluation, we call it special assumption. In any case, even special assumptions should be reasonable, but sometimes it is used to just to illustrate and to see and to illustrate possible changes of value if some facts existing now are different. Equity valuation. First of all, I would like to start from the fact that there are two ways of estimating of equity valuation. First is directly calculate cash flows to equity, and the second is to start from the cash flow to enterprise value. This is enterprise value. This is interest-bearing debt, and the difference between them is equity value. When and why free cash flow to enterprise value is more preferable if the assignment is to evaluate the equity value. First of all, it is more useful and more justifiable to use such a valuation in case if forecasting of exact sums of long-term debt is a difficult exercise, because it is not always possible to use in cash flow projections exact sums of long-term debts and costs related to such a debts. And sometimes it becomes a challenging task. Debt analysis. In both cases, the appraiser should analyze the long-term debt. Sometimes reclassification or normalization is required, especially when valuation is required for deal purposes. When and why cash flow to equity is more preferable? First of all, we use directly cash flow to equity when evaluating a banking business, and sometimes in some cases if the task is valuation of professional services firm, there is no need in estimating long-term debts because they usually don't have such a debt. And some aspects related to shareholdings valuation, not total equity, but shareholdings. First of all, premiums and discounts are matters of particular deals and are very difficult to be justified by any third party, including independent appraiser. And I can state that even American Society of Appraisers does not recommend providing recommendations for deal purposes in that regard. The next important thing is that sometimes the size of the shareholding impacts on the projections the appraiser uses, because the level of control sometimes is essential to make some projections related to significant changes in the business. So evaluating an equity and evaluating a share holding for the same company, sometimes you cannot use the same projections in case if such a projections are related to significant changes in the business. A lot of capex, some I don't know, reconstructions, etc., etc. Okay. Valuation of enterprise value. The result will be the value, the total value of 100% of control plus debt. How often we use valuation of enterprise value? As I said, for deal purposes, it is also required to perform such evaluation in case of providing valuation for IFRS purposes, International Financial Reporting Standards. It is often required to use enterprise value valuation in case of economic obsolescence estimation, and it is also important to make the same, to use the same concept in case you need valuation of a complex of assets for various purposes. It is also important to remember that sometimes the potential buyer or seller requires not equity valuation but enterprise value valuation if such a purchaser has certain relation to debt and also in the cases when the debt may be restructured and its exact sum is also a matter of negotiation between parties, and sometimes they just ask only enterprise value valuation and came to the agreement themselves about the value of the equity or maybe of a shareholding. Okay. The next topic, complex of fixed assets as a collateral. Цілісний майновий комплекс або майновий комплекс, як то кажуть українською мовою. The term integral property complex, as I said, цілісний майновий complex, is widely used in Ukrainian valuation standards and and in various legislative acts, Ukrainian legislative acts. And such a term sometimes results in wrong understanding of local appraisers. What does it mean? And sometimes instead of valuation of such a complex of assets, they perform valuation of business, enterprise value of, or maybe equity value, despite of the fact that it is not the same concept. 3 steps of a complex of fixed assets valuation are, first of all, indeed, valuation of an enterprise value, then deriving non-current assets value as a whole from the enterprise value. You have to do that because it is not the same. And then the valuation of the assets other than required, which are the part of the complex, which is the subject of valuation. And the main problem, not issue, but a problem for local Ukrainian appraisers is that they almost never analyze whether this complex, which is the subject of valuation, which is a collateral, may be sold on the market. Is it marketable or not? It's really a problem for a lot of banks. Sometimes you can see that I don't know, some assets, I don't know, in a big factory or plant, which never can be considered as a separate asset, which has separate value, are estimated for a huge sum, and the bank uses such evaluation only as a, I don't know, as a blackmail, as they say, як то кажуть, шантаж. So it is not an asset which may be transferred in the cash, but the appraisers very often ignores that and just use valuation using cost approach and even market approach for that. This is the illustration. Enterprise value, working capital. This is non-current value. And as I said, sometimes you have to subtract from this sum the values of assets which are not the part of the complex of fixed assets. And one more example related to using assumptions when estimating the complex of fixed assets as a collateral. It is a practical case. For example, we have a company that produces products that are in demand, but the company uses obsolete technology, which is being hosted by the modern one. Change of technology for such a company requires complete reconstruction and renovation, and consequently requires a lot of capital expenditures, investments. If the task is to make valuation of such an asset as collateral, the company will have a certain limited time frame. This is the assumption which has to be used. During the mentioned period, assets are taken out of services. It's a concept of ordered liquidation. And the terminal value will be estimated as the outcome from the business liquidation. And provided that those assumptions are sound, they are correct, they are common, not special. But if significant reconstruction is required, is forecasted, the appraisers deviates from the purpose of the valuation, meaning collateral. The same company and we'll use special assumptions. For example, large-scale reconstruction during certain period, and terminal value will be estimated based on the assumption that the business is completely renewed. For example, a Gordon model. Okay, but such an assumption is a special assumption, and it can be used only for valuation of some investment value, not for valuation of fixed assets, and it may be also an issue if the task is to evaluate a minority shareholding. As I said, because there may be some restrictions related to the rights of the owners of such a shareholder to provide large-scale reconstruction. Okay. Economic obsolescence valuation. I would like to start from the definition. What does it mean, economic obsolescence, based on the IVS, the latest version? Any loss of utility caused by economic or locational factors external to the assets. So it is not physical deterioration, it is not functional obsolescence. This type of obsolescence can be temporary or permanent. This is economical obsolescence, and it relates to specialized assets only, assets which cannot be estimated using the market approach. First of all, it is very often required to take into account the presence of economic obsolescence when performing valuation for IFRS purposes. The main idea is that the market value of the non-current assets as a whole, like cash generating unit, is compared with the sum of individually evaluated assets. So first of all, we make valuation of each assets from the list of the company, and then making some estimation of the cash generating unit, just compare these two sums. And when the sum of individually evaluated assets, the total sum, exceeds the value of cash generating unit, that means that there is some economic obsolescence of specialized assets of the company. This is some demonstration. This is the summarized value of assets evaluated by using appropriate approaches, cost, market, or maybe more income approach. These are specialized assets. They are estimated using residual replacement cost approach. Then these are market value. It relates mainly to machinery, equipment, furniture, etc., etc. And maybe some sum of assets are subject to liquidation. Okay, then we performed valuation of non-current assets as a whole using the CF method, so-called cash generating unit, and subtracting from this value the value of the assets that were evaluated using market approach, we can obtain the economic obsolescence of those assets, specialized assets. And two remarks. First of all, after obtaining this value, we have to be sure that the remaining value of specialized assets are not less than their value of liquidation. This is essential. And one more remark. Economic obsolescence is not the same as an impairment according to IFRS 36. I would not. I don't think it is worth to go deeper, just because it's a big topic for discussion. But just to remember that when we have deal with the economic obsolescence, it does not. Sometimes it does not mean that the result will be the same if your task is to make impairment test according to IFRS 36. Coming back to the valuation of complex of assets, we have to remember that sometimes the cash flow are generated not only by the assets which are the subject of your valuation, because the subject of your valuation may be limited but certain assets, but the cash is generated by some other fixed and intangible assets. And sometimes if you are dealing with the company which produces some products with known trademarks, the input of trademarks should be also taken into account and subtracted from the cash flows. And in certain cases there are some more complex methods, but in any case we have to take into account the fact that the cash generating unit is generated by the business, but our task is to evaluate some limited list of assets of this business. It is not the same. The other example relates to real property valuation. For example, hotel business. This is invested capital value. We did it. But our task is valuation of the real property, not the business in a whole, but real property. What should we do in such a case? First of all, we have to subtract the working capital, and as a result, to get the value of non-current assets. After that, we have to somehow take into account the fact that for example, the hotel relates to some chain with well-known trademark. That means that the value of the brand should be somehow subtracted from the result of our valuation, one of the methods to do that is to brand. I will show you it, to include, for example, royalty payments to the cash flows, to the operating expenses. After that, you have to take into account that in some cases the company is operating by using specially prepared management, and some costs should be also subtracted from the operational expenses. Then individual property. Individual property means рухоме майно. Machinery, equipment, furniture, I don't know, pictures, etc., etc. And only after that we will get the result as a real property. But as I said, these two elements, brand and management, they can take place only if the subject of valuation is is a hotel related to well-known chain of hotels. Only in that case. If, for example, our subject of valuation is a local brand hotel, locally known only, such expenses may not take place. And this is everything I said you. Working capital, royalty payments, capex. There are some, in some cases, there are some capex that are obligatory to make to maintain the requirements of the owner of the chain. And some examples. I'm sorry, just a minute. For example, chain of petrol stations. Some important points here. First of all, if the assignment is not to evaluate the business, but to make valuation of certain stations, of a group of stations, as a property, in such a case, the trademarks should not be included to the valuation, which means that we have to use average market markup and maybe some loyalty programs which are used by the company should also be excluded from our projections. Maybe in some cases the wholesale markup should be also not taken into account in such evaluation. And it is also important to understand that usually the chain of petrol stations include, it is a large business with the administration, with the нефтебазы. Yeah. So sometimes you have to make some amendments in operational expenses when evaluating such an asset as a property, not a business. The next example relates to oil and gas production company, or maybe to mining company, The important remarks here are as follows. First of all, we have to get somehow evaluation of reserves and resources. Without that, you never can perform valuation of any mine of oil and gas company which business consists of extraction of oil or gas. Then you have also to obtain somehow extraction plan. This both requires special knowledge and special experience, and it should be done by knowledgeable, by well-known international company. Almost always you have to check numbers in the extraction plan because they may be outdated. Then the evaluation should projection cannot be limited by certain years. We have to make projections up to the end of reserve depletion. Sometimes there is need to take into account cost of prolongation of mineral rights. Sometimes such a costs are substantial numbers. Then the main issue in such valuations are reliable long-term projections. It usually becomes a topic of discussions between parties. And also, we have to remember that assets retirement obligations, ecological, land reclamation liabilities also should be included to the terminal value of the projection. One more example is valuation of a natural monopolist company. Natural monopolist means, I guess you know, but just in case, for example, our Oblenergos or Teplokомунэнерго, these are companies which are natural monopolists. What should be considered when performing valuation of such companies, of their business? First of all, we have to study or know is better before starting such evaluation, regulatory regime. Sometimes it's a number of regulations, legislative acts we have to know in order to make any projections related to tariffs and other costs, capexes, etc., etc. The next, we have also to be aware that there are some draft legislative acts related to the regulation of natural monopolists in Ukraine. Now we have the same, exactly the same situation. We have some regulation, cost plus, for example, cost plus principle for tariffs of natural monopolists, both in heat distribution and in electricity distribution. But we also know that it will be changed. There are a lot of acts, some of them are draft, some of them are adopted, and the situation will change. And we cannot make evaluation based on the current situation, current understanding what is tariffs and what is requirements, what are requirements to such companies. It will be changed, and without knowing what the changes will consist, we cannot do such evaluation. And sometimes business valuation should be also done in tandem with its assets valuation, because sometimes assets are the basis for estimating of their tariffs, so-called regulatory asset base. And 2 points related to discount rate for such a calculation. First of all, beta and specific company risk premiums in WACC calculation may depend on comparability of regulation in different jurisdictions. We cannot easily use, I don't know, Bloomberg or something else and use betas and other risk premiums from the companies which operate in other jurisdictions before we know that their regulatory regime is really close to our. And the next thing is we have to remember that that the natural monopolists almost always have guaranteed demand of their services. And the last thing is purchase price allocation. It's a huge topic. I have a separate presentation related to that. I will limit this topic by 2 slides. And they both relate to intangible assets valuation. First of all, for intangible assets valuation, excess earnings method is used, and it is based on discounted cash flows technique by using cash flows generated by a group of assets which include the subject intangible asset. And the main task for an appraiser is to somehow to extract from the cash generated by all the assets everything which have no relation to the subject intangible assets. And there are various of techniques related to that, and in general, from the helicopter point of view, we can see that the main thing is to determine the contribution to cash flow from assets that are other from the subject intangible asset, and these usually has a relation to working capital, fixed assets, trademarks, qualified personnel, and maybe some other identifiable intangible assets. I would like, this is the algorithm. First of all, we have to identify intangible assets that will be evaluated using the technique of EEM technique. Then determine revenues in which subject intangible assets are involved. Then determine costs associated with such revenues. Identify other assets involved in revenue generation. Determine the reasonable profitability of each group of such assets, intangible, tangible assets. Then separate the conditional return on its investment of assets other than intangibles. And then using residual principle, calculate the cash flow attributable only to intangible assets. But as I said, it's a really big topic for discussion, and I'm not sure if it is interesting for you. It relates only to IFRS 3 business combination. We tell it also, we call it also purchase price allocation. This is all I I can share with you. If you have any questions, I'll try to answer.
Thank you for this absolutely valuable knowledge that you shared with us. You mentioned in the presentation that enterprise value valuation should be used only for 100% control when you value full control in the business. And then you also mentioned that the American Society of Appraisals recommends not to give the estimates for the cases when there is discount for minority shareholding or premiums
marketability.
But then my question is that if you look at the equity analysts on the stock market, they're doing absolutely the opposite. They usually value in most cases, enterprise value, and they just divide by number of shares, which is by definition the situation of non-controlling stake. So my question would be, what's your suggestion for the analysts on the stock market? What the approach should be here when they're valuing and giving recommendations for the one stock basically you can buy on the stock market?
We mean one share in the stock.
What's your recommendation for the analysts who are doing the equity valuation for the stock market, for tradable shares on the stock market?
As I said, I'm not sure if I understood you correctly. What we're doing, if the task consists of valuation of, for example, some shareholding, for example, 10% or 5% or 50%, the first step is to make valuation of the equity and then just to calculate using mathematical действие, just to subtract the certain percent, and after that don't use any discounts or premiums, but it does not mean that in the practice there will not be any amendments to the value the appraiser obtained. What I said is that it is almost impossible to envisage all factors that will impact on the decision of both parties. This is the only what I said. For example, if this is true only in case you are doing independent valuation. In case you are supporting some of these parties, seller or buyer, it's up to you to decide to make some suggestions based on your knowledge about their goals and abilities to buy or to sell. Я відповів на питання? Thank you.
Thank you for your presentation. I have one question regarding the integral property complex, regarding целостный майновый complex concept. So you mentioned that only non-current assets component is considered for this valuation, if I understand correctly. So, for example, if we consider a company which has manufacturing and distribution parts, and for manufacturing it's easy, you have land, you have building, you have product lines, it's fixed assets, so you consider them. And if we also consider distribution with leased trucks and leased warehouses, but they have a huge amount of capital tied in the inventories and in accounts receivable. But if all of those are current assets and they are not considered, so is it true that for integral property complex concept, the distribution basically is ignored because it's current assets?
It depends on the assignment. Sometimes, yes, you are right. What I mentioned is non-current assets only. But sometimes if, for example, a bank is interested in pledging not only fixed assets, the task may consist of valuation also of some of current assets. But in my example, you are right, I was telling you about only of about non-current assets consisting of fixed and intangibles. But it is not. It does not mean that there is no cases where current assets also has to be evaluated.